A very good morning and welcome to our second panel discussion of the Cross-Border Distribution Conference. Has the game changed for cross-border fund distribution? I'm Matthew Vincent, regulation correspondent of the FT, and I've already been hearing from speakers at today's event how the last decade has really seen rapid growth in cross-border funds investment and fund registrations. However, we are all very, very aware, of course, that the past 12 months has seen this trend come up against the economic uncertainty and market turmoil caused by the onset of the COVID pandemic, a volatile geopolitical environment with a new US administration, new foreign policy potentially, and obviously regulatory change with Brexit, all of which will impact the marketing and distribution of funds in some way, but none of which will stop asset managers wanting to market and distribute their products globally. So the question we have to address today is, has the game changed? Now, don't ask me, because I've spent the last 12 months obsessing about post-Brexit equivalence regimes and the travails of the UK's Financial Conduct Authority. Let's instead ask our expert panel. We have today with us Evert van Walsum, head of the Investors and Issuers Department at ESMA. Also have Marco Zwick, director of the Luxembourg Supervisory Authority. I'm not even going to attempt to pronounce Commission de Surveillance du Secteur Financier for that very reason, because I've got a terrible accent. And we also have Gina Miller, who is founding partner of SCM Direct, a near full-time campaigner for better regulation and a full-on critic of the aforementioned FCA. But that's for another discussion another day. Before we start this discussion, though, a brief explanation of the format and how it's going to work. I'm going to put questions to our panel for around 40 minutes, and then we'll have 10 minutes for your questions. You can type them in using the chat function on your screen. I think there's a little button at the bottom called Ask a Question. Click on that. What you type in will then get passed on to me, and I'll put it to the relevant panel member or members. You can also use the chat to ask questions throughout the day in different sessions at the event, and you can post your thoughts on anything that we talk about in this session on social media using the hashtags crossborderLU and crossborder2021. Now, if you want to watch any of this again, you can. All of the sessions. Oh dear, that's the hotline ringing. Hopefully that will stop. That will stop in a moment. You can watch the sessions again, as I mentioned. Ignore that. All of them are going to be available on demand for 2 months at crossborder.live.ft.com. You can also head over to our sponsor pages and visit the sponsor hubs at any time. There's a person who hopefully is aware that we've got weighty issues to talk about cross-border funds distribution. Good. Let's begin then, and let's start with the issue that has affected all of our lives so very profoundly, COVID-19, the coronavirus pandemic. It's obviously had an impact on fund distribution across Europe. Gina, can I come to you first of all? I mean, you work in the fund business day to day. How has the pandemic affected distribution?
It's been tough in that people don't necessarily have their sights on investing at the moment or financial health. It's more about their physical health. And obviously there are challenges in the physical working, not being able to go into the office. So, keeping teams motivated has been difficult. But from a regulatory point of view, for us in the UK, it's been extremely difficult and continues to be so because we are just sort of in treading water. We find it very difficult to know what we are to do from the point of view of ongoing regulation. I mean, we, for example, were very eager to see what would happen with the reverse solicitation. And as we saw, the ESMA came down very heavily on those firms who were sort of sidestepping it. And so for our EU clients, we have had to pull a drawbridge up for the moment because we have no idea how that will work in future. So I think for us in the UK, the biggest problem we have is uncertainty and not knowing or getting any sort of an insight from the UK government or regulator about where we go. We obviously have temporary regimes set up with particular individual member states, but they don't cover where we happen to be distributing at present. So we've suspended that. And, we are very concerned about certainty around data sharing, data flows, where that will go. We're also extremely concerned because if we do not seek alignment or equivalence and the EU rushes towards a huge sway of new regulations and reviewing of regulations such as MiFID, PRIPS, the more ambitious review of the CMU that was published by ESMA or the EU Commission on the 24th of September, talking about things like a single product platform across all member states, where will that leave us as a small firm? Because I do think that the bigger firms will manage and find, but it's going to create, in our view, being a smaller size firm, an online manager, that the smaller firms will be in a different playing field. It's going to create a very uneven playing field for us because we won't have the resources to just move swathes of our business and staff to the EU.
Yes, of course, and thanks for that that particular perspective. Marco, can I come to you and the Luxembourg view? What's been the impact on Luxembourg funds from a distribution and also a fund liquidity management perspective?
Yeah, thank you, Matthew, and good morning to everybody. So, indeed, it has been a heavy season, let's say, since March last year. I think what we have seen, especially on the fund risk management side, was really all the questions linked to liquidity management, which, of course, have a direct impact on distribution as well. And saying that, we observed market volatility going up by 6 times as compared to normal levels. And that can, of course, have positive outcomes, but it also can have negative outcomes. What it meant for Luxembourg domiciled funds, which we supervise, it would have triggered a drop down from 4.67 trillion to 4.15, which is roughly, if you make the mathematical calculation, it's 11%. It doesn't reflect the whole drop actually in terms of overall market impact, which was obviously much higher, but it also shows actually the diversification of the investment strategies of the funds, which also meant that you could have drops in one area and you still had some stabilization in others. We have reached, and we have published the figures about a week ago, we are now back to almost 5 trillion. So we have seen that everything which had lost was recovered back in August last year. And since then, we saw also massive inflows into the fund. So the positive figures are not just stemming from positive market evolutions, but it is also actually net positive sales, which I think on the distribution side is very, very important point to mention. Now, what was the real impact? I mean, like Gina was saying on the private sector side, everybody was extremely busy, and we were facing right from the outset many questions around the management of the funds, managing some redemptions from some type of funds. So there were questions around any liquidity management tools, how to use them, what tools to use. And I think the experience, I must say now with hindsight, after this initial crisis, is to say that the market remained quite robust. Having said that, and I'm not complacent here, we also know we had some issues with respect to one question which is as old as the fund industry is, which is the liquidity mismatch between your liability side of the fund, so your investor side, and also your fund management side, and that's especially for open-ended funds a remaining question. And I think we also saw in particular with respect to money market funds, some questions being raised at that time, because we also saw that the interventions by the central banks were different. So if you take the European Central Bank, they would have had a different intervention as, for instance, US Treasury or UK Treasury. So I think this is just to show you the complexity of the things which we mentioned. And I think we may touch later on a little bit about the lessons to be learned. But of course, there are also some points and some ongoing investigations which happen right now, done by national control authorities together with our colleagues also from ESMA.
Yes, I realise it's rather early to perhaps try to look at lessons or look to the future. But you mentioned the recovery that has been seen and some of the positives in more recent months. So, Evert, I just want to come to you and attempt to look ahead to cross-border regulation in a post-COVID environment. How do you see the regulatory landscape when we finally emerge from this pandemic, as we all hope to do so?
Thank you, Matthew, and hello to everyone. So I think for the fund area, it's quite an extraordinary situation. Is that four elements are coming together and have come together. It's clearly the aftermath of Brexit. It is COVID crisis response and the follow-up, the CMU, and reviews of major pieces of legislation in the fund area, and they're all coming together. So in that sense, it's quite a lot of moving targets out there. To start with the biggest stone in the pond, and it was clearly the COVID-19 crisis, immediate crisis, basically in last year, March, April, when the fund area was most affected. It was not banking this time; it was the fund area, where a lot of worries were around, and I think Mark already mentioned this, especially certain types of money market funds. But clearly, a lot of worries also about liquidity issues at UCITS, especially. And this being a huge market, certainly something that has caused quite a crisis response from ESMA side, where we've endeavored to coordinate actions across Europe to make sure is that we're all aligned on response, getting the right data also, and see how liquidity management tools were used. I think taking the post-COVID, we're not out of the woods yet, but as Marco mentioned, markets have stabilized. We don't see anything like liquidity stress as we see last year. At the same time, a lot of regulatory work streams are underway internationally, IOSCO, the FSB, but also clearly at the European level. So there is a planned money market fund review from the Commission, and ESMA is also involved in launching a consultation paper on recommendations for the Commission on this side, because it is clear is that in the money market fund area and certain types of money market funds, there's at least notion is that without central bank intervention, bigger accidents could have occurred. So that is, I think, one of the focal points. The other one is, and it was follow-up of the ESRB recommendations that were established last year, and ESMA published a report on those ESRB recommendations, is to look closely to available liquidity management tools and look closely to the coordination of using those liquidity management tools across the fund area. So I think those are very specific crisis responses that are happening. Again, I can go on the other CMU-related regulatory framework that is going to be changed. But I'm also conscious of time, and I'll mention it clearly. There is the LTIF review, which is going to start. There is already the regulation on cross-border fund distribution, which is being rolled out. And the planned AFMD review, I think, may not be necessarily COVID related, but it's one of the bigger chunks of review of the fund regulatory area. And last but not least, we recently published with the other ESMAs our draft RTS on PRIPS, which also has a big influence, I think, in the fund area. And I'll stop there.
Thank you. That's a very long, comprehensive list of measures. Gina, from your perspective in the industry, do you think that anything that we've seen over the last 12 months in the sort of regulatory response to COVID is going to change things in the future, or is it too early to say?
I think it's too early to say, but there's one thing I think that we in the UK have got to think about, and I think actually the whole of the European Union, is the increase in online scams that have happened and, mis-selling that's happened, or just the scandals and the adverts, the online scams. There's been something like a 300 or 400% increase in those. And it's about regulating who regulates the online, the financial ads and those financial crimes, if you like, that are happening. Because in the UK, we say that it straddles the perimeter for the FCA, because, the FCA can look at these, because if it's something that inhibits the reputation of the industry, then it is something we can look at. In the UK, I have to say, I'm a firm believer that it should be under the online harms legislation that's coming in, that financial harm is something we have to look at. But I think as an industry, we really do have to look at this, because it does impact on the reputation of the industry, industry-wide, that these financial scams are happening. So that's something we've already seen and we have to urgently address. And I know the EU is looking at some of this as well. But then the other thing, of course, is that we are seeing a different mindset from consumers who are looking towards more ethical ESG products. So there's a lot more of conscious investing, if you like, wanting to have a good return as well as doing good. Our mindsets have changed through this pandemic. And so I think there is an urgency around as well what we do on the reporting of ESG. Again, I know that the EU is bringing, has got its legislation later this year, and it's talking about self-certification. But I have to say, I'm not a fan of self-certification. I think we have to go further. But it then has an impact on us as an industry, because you can have, if we resolve the issue of benchmarking on ESG and all the data reporting and third-party issues that there are, then there are problems within organizations about the skills in-house to actually produce these reports. So I think we have a skills gap, but we also have a regulatory gap when it comes to ESG, which is something that is being brought more and more growing. And also, finally, the profile of those investors in ESG ethical products are more inexperienced, younger investors. So I think we have to go further in making sure that our communications, legislation, disclosures are understandable and not just, in technical expert speak.
Yes, a very good point. And I think ESG is going to be a big topic in a lot of the following sessions at the event today. So thank you for pointing that out, Gina. Just lastly, Marco, on the pandemic. So I don't want to make this session entirely focused on it, but from where you're sitting, do you see any possible changes in cross-border regulation as a result of the events of the last 12 months?
I would say, Matthew, what I see, and I think what the market sees, is all the actions which have been taken. It's not so much around cross-border distribution as a result from, how should I say, from the pandemic, but it is much more a broader question. So what we see, where we have a lot of focus, is obviously on liquidity management. There was the supervisory action from ESMA on this, with where some results will also be shared going forward. But if I step away from that topic in particular, I mean, there are many other changes which from my perspective have already been started before anybody spoke about COVID-19. And just thinking about, first of all, the regulation on facilitating cross-border distribution of collective investment undertakings, where we had the transition immediately on the 1st of August 2019. We have also a directive which should be transposed by the 2nd of August this year. So these are initiatives which have been orchestrated, initiated actually long before the crisis. And I think the objective is actually also, Evert was speaking about CMU. I think we all know that it is really about having a single European market which is working correctly. Another point which always impacts distribution, and I know it's a topic which people often do not speak about, but it is anti-money laundering, counter-terrorist financing. And I think there also we have seen enhanced focus in Europe, also outside of Europe, but we know that the FATF standards, which go back already many years now, with the last publication going back to almost 9 years. But the first recommendation speaks about a risk-based approach. And I think that's where, for instance, in Luxembourg, we have done the national risk assessment, identifying this sector as higher risk or higher inherent risk, which also means that you need to do more, and doing more also means that a lot is based on intermediation, and that's what we see actually, that the funds are being distributed via other professionals who themselves in their respective jurisdictions are subject to AML rules. And so this is just one example where you need to be very clear on which risks you take geographically, which channels you use when you distribute the funds. And also, at the end, we will also publishing, just for the interest of everybody listening here, a subsector risk assessment, which even goes much deeper into areas where we believe that more needs to be done. So that's clearly also a very important part in this whole regulatory framework. And that has been started years ago, but it's going to continue, obviously. Then we have all seen the emergence of AML colleges, which also, for people in the private sector, but also for national control authorities, is also something new, and it fosters actually international cooperation, I should say here more at the European level, because these colleges are meant actually, for the time being at least, are coordinated via the European Banking Authority. Then MiFID II, which is another piece of work which has been started long before the crisis. Then a new supervisory briefing by ESMA has been kicked off on costs for funds, which I believe is also important from a distribution perspective. So you see, we could continue. I could continue with PRIPS, which you mentioned already. We could speak about IFND. And then I put actually for one of the main parts, and there I come back to what Gina was just saying, is ESG, sustainable finance, which obviously is not really a new topic. And my experience is really that we have been discussing this for many years in the past. It's not because something was directive that in the market actually people would have thought about sustainable finance. But I think there are two areas here which I would just like to flag. The first one is how, what's the depth of the information which is provided to investors. And I think that's, for me, one key area, and that's also linked to the taxonomy, to all those discussions which we currently have, to the RTS, which are published by the European supervisory authorities. But I think for me, at the end of the day, it is about attitude, and it is also mainly about the correct disclosure to investors, because one thing is clear, if we want to be successful here as a market in this, we cannot reduce it to a marketing exercise. And I think that's very important also from a regulatory perspective, that we are very clear, that we explain to people clearly what the fund is doing, what the manager is doing, and what the risk reward is. And I think that's just one area on which regulators have focused and are continuing to focus. So post even COVID-19.
Yes, certainly a very important area of focus there as well. And I'm very glad you mentioned costs, and you also mentioned anti-money laundering, because I want to come on to both of those. Evans, let me ask you about costs, fees and commissions. I mean, is there a sense that they are helping to break down barriers? Or are they still an issue in cross-border fund distribution?
Yeah, thank you, Matthew. I think, as you may be aware, cost is one of the union strategic supervisory priorities of ESMA. So in that sense, it's needless to say that indeed it is an issue that is of high interest. I think one of the issues is related to the CMU. So to be able to have the CMU work, you need retail investor participation. And as one of the elements, clearly, because CMU is a multi-pronged animal where you need multiple elements coming together at the same time the right way to make this work. But one of them is indeed retail investor participation. A lot of funds, so a lot of cash is invested in, it's not invested basically, but it's sitting on a savings account, and we need more participation. So that can be via pension funds. The fund area plays a big role in this whole area. The fund area could, in theory, have and it does to a large extent, a very important channel in the CMU, and also a very important, almost societal benefit of retail investors participating and saving for their retirement, for example. One of the elements there is the risk that you're exposed to, and we've seen quite some bad investments in recent times of retail investors, but in the fund area this should be different. The other element is clearly cost, and you may be aware that ESMA has produced some reports on the average cost for example, for fund categories. One of them is done on the 10 years basis for UCITS equity funds, and the average cost is 1.7% per year. In that sense, the consciousness of cost, or transparency of cost, to retail investors is quite important. And that means is that the cost as such is transparent for investors, but also comprehensible. So that means something about how you disseminate the information to a retail investor. At the same time, you have the notion of undue cost and in the fund area. And that's where also Marco was referring to. We produced a supervisory briefing on this particular element where NCAs should look into how this is being dealt with at the manager level. We also have worked with the NCAs on a common supervisory action on cost and fees, and this is clearly going forward because it recently started. And a common supervisory action is that all NCAs are going to work on this topic in a structured way. Also looking at our compliance with the guidelines on ETS and other UCITS issues, which is quite relevant also in this context. So one other thing, or two other things that are related to this is our earlier work on closet indexing, which is related to the theme of cost efficiency. And finally, last but not least, we also published the guidelines on performance fees recently, which also ties into this bigger theme. So yes, quite important because 1.7% in a yearly basis doesn't look like much, but on a 20, 30 years basis, it is quite relevant, and certainly for retail investors.
Extremely relevant for retail investors, and I I can't have a discussion about fund costs and the impact on retail investors without bringing Gina in. You've been vocal on this topic for many years now. I mean, I remember our sort of email correspondences going back ages on this. We've heard what regulators are doing about this. Is it enough? What does the industry need to do more, do you think?
Well, as you say, Matthew, we've been talking about this and campaigning on this since 2009, and actually worked with ESMA on Article 4 on the drafting of that text. And I have to say, at the time, we were disappointed because we felt that it didn't go far enough. And actually, cost calculation methodology is very, very important to this. To mandate form and format is very important to promote understanding and across all products, because investors don't necessarily look at one product to the other. So there has to be some harmonization between PRIPS and MiFID on costs going forwards. And I think it is very important, that form and format, because here in the UK, we know that even advisors contact us on a daily basis saying that the OCF ongoing charge has all charges, and we have to explain that not disclosing implicit transaction costs will be detrimental to their clients. So I think it's really important that the cost calculation is a part of this MiFID review and PRIPS review process. On the inducements, I believe the ECAs are waiting or wanting feedback from the Netherlands and the UK, where we've obviously banned inducements. And what I can say is the research in post-RDR in the UK has shown three things. I mean, I know BaFin disagrees and says actually it's not made much of a difference, but I would argue that BaFin's research that it wasn't simple enough for people to understand. But what we found in the UK is that firms are selling fewer products that pay high commission since RDR, sell products that pay many more products that are little or no commission, and it's given the opportunity for ETFs to really flourish in the UK and portfolio managers like ourselves. And that we've now got costs on the radar, because when you can't control the future, the one thing you can control as an investor is costs. And how can you possibly make an informed choice if you're denied two basic consumer rights? One is to know how much you're truly paying, and the second is to know what you're truly buying. So transparency of costs and holdings is something that I think the regulator needs to do more on. And as you say, Evert mentioned closet index tracking. Again, Matthew, we've been talking about this since 2010, and we spoke to regulators across the EU about this. But it's sort of the discipline that I say transparency of holdings that I would apply to closet index trackers. I'd actually apply to ESG and say that in ESG, the issue we have is that people have a different perception of what's ethical. All five of us or four of us on this call would have very different views. So I think unless we have transparency of holdings in an understandable format, people will not be able to make that informed choice. I think we have to give people the information so they can make the best possible choice that suits their perceptions of ESG, their perceptions of risk. And I think it's really important. And finally, I think we haven't mentioned this, but I think the regulators need to look at performance. The way performance is being reported and illustrated is quite confusing. I think if we want to encourage longer term investing, yes, you want performance illustration to show what you've bought, how that's performing, but then perhaps we should only have a 5 and 10 year. I just think there has to be the regulators should be looking at how performance is illustrated as well.
Yes, it's transparency and consistency, I think, is the combination that is required. Gina, you mentioned MiFID and the inducements rule review. Marco, what do you think needs to change, and why?
Well, I think first of all, I would say I agree with what has been said, and I think it's really the point. Sometimes I wonder whether we do not limit our debate too much on costs rather than looking at the total picture. And as none of my colleagues from the FCA is on the panel, I know in the UK there is more the question around value for money. And I think And having said that, I mean, you mentioned MiFID II, and obviously there are some big changes. One of the changes is really to take more into consideration the different categories of investors. I mean, we will still have retail, professional, eligible counterparties, but it is more the level of disclosure which is going to be adapted, because sometimes we hear as regulators that the current rules did not always improve the protection of the investors, but rather hindered the smooth execution of investment decisions. And that's not me saying it, it's something which we often hear from the market. And I think we should, and we are going to focus really the disclosures on where they really make most of the sense. Does it make sense to have big disclosures to professional investors who themselves perform a due diligence on the fund before they invest into that fund? And I think at the end of the day, we have really to get clear on who needs more protection. And I think that's coming back to the spirit of MiFID I. And I think that's, in my view, a correct evolution, that we focus much more on that. And there is also the big question around the qualification of investment research as an inducement, where we also see that there are now changes, of course, subject to certain conditions, but that investment research then provided by third parties would not be considered as an inducement, again, under some disclosure rules. And I think it's all linked to conditions, but at the end of the day, the idea is really, we have learned from MiFID I, which was really a good framework to start with, that there are maybe areas which need refinement. And I think what we are not, in my view, not seeing under MiFID II is a big revamp of the concept, but it is really a fine-tuning to make the protection even more, to ensure that the protection really happens at the level where it needs to happen to the type of investors who need it. So I think that's how I see it. But I think it is an evolution into the right direction. And yes, it's going to be another debate around costs, and I think we need to have this debate. So I do not want to say we should not have that one. But I remember Gina was just saying, well, we have to look at also the performance of the fund, and I think that's obviously coming nicely together. By the way, the whole debate around review of costs is not just limited to MiFID II. We know we had discussions about index trackers and other items, and from us as a regulator perspective, it's always the same. It must be done in the way what you have promised, you need to achieve. And if you have costs which are linked to it, you need to disclose them. These costs need to be really proportionate to the service. Now, I do not think I say something fundamentally new, but I think it's much more positioning it to the different levels of investors as well.
Yeah, I'm not sure it can be said enough, really. Thank you for that, Marco. Now, I'm going to go to our audience questions in just a moment. So please remember to click on the Ask a Question button and type yours in if you'd like me to address it. Very, very quickly, though, I said earlier I would come back to the anti-money point that Marco raised. And Gina, is this something that you think fund managers are paying enough attention to? Does there need to be more focus on this, or is the industry doing a good job?
I think at the moment we're doing a job, but it's I go back to my first comment of the unknown. We don't know what's going to happen in the UK, and I think this is one area that I know Europe is worried about, and I have to say we are worried about here in the UK too. But I would hope that we keep on the high levels of checks and that we're doing. And I think the thing that's been revolutionary in that is the digitization of it for us as managers, is being able to do these checks online has been incredibly efficient for us as businesses. But yes, I think it comes back to my point in the UK that we don't know we don't know where those regulations are going to go in the future.
Okay, well, Marco, obviously, I mean, you do have a specific regulation which makes points about investment funds. Just very briefly, what are the key areas that you think our audience today needs to be aware of?
I think, first of all, if you read AML laws internationally, people speak about clients. So what we wanted also to specify is that client can also mean investor. And then you have to see at which level, as we see, you have a lot of intermediation in the fund distribution space. That's not just a question for Luxembourg funds, that's a question internationally. And there I'm optimistic for the UK because I think all this is driven also by international standards, driven by the FATF. And I remember, one paper, in the case you do not know it, I would recommend for reading is the risk-based approach for the security sector, which has been released in October 2018 and which advocates actually a risk-based approach. I think that's what is really important these days. Let's see where the risks lie and really focus on those. Because with the best will in the world, you cannot check everything permanently. So I think you need to choose your battle. And I think here we speak also about a very important industry, which I believe has taken a huge part of its responsibility in it. And I think that's good news. So what we have also introduced as a concept here is not just to look at the liability side of the fund, which is really the investor side and knowing where the money is coming from, but also performing some type of due diligence on the asset management itself. So if you are a fund manager and you invest the money on behalf of the investors, that you do not take risks actually in doing money laundering, and I think that's really something which we have anchored also in our jurisdictions, in our laws, sorry. And some key points to remember as well is this shouldn't be a theoretical debate about risk-based approach. It should be something which is living, and what we expect when we visit is so that they can demonstrate to us that they have done the exercise. And if somebody tells me these days that everything linked to fund distribution is low risk de facto, I have an issue because we have international standards and we have also studies which we have done, and we have the national risk assessment for Luxembourg in particular, where we say it is not low risk. So I think then you need to argue really why it is low risk or what you do in order to have low risk. So what I would really ask is that people in fund board meetings, for instance, they really have a discussion around the risk appetite, and the risk appetite should really reflect international standards and not just a perception that everything is de facto low risk. And we have seen actually a lot of change when we read board minutes and when we speak to board members. We see that there is really an increased awareness in that respect. So it's encouraging.
It is encouraging. Thank you very much indeed, Marco. Let's take some questions from you, the audience, now. And let me turn first. Well, here's one on a very important theme of trust, and I'm going to come to you first, Evert, with this. Our audience member asks or says, "Trust is fundamental. How can we enhance regulation to better achieve this?" What's your view? How can we restore trust in the industry through regulation?
Yeah, it's a very important question because it's fundamental trust in the markets, trust in the providers that are out there, and clearly a financial market can't function without trust. The only question is, can you regulate for people to trust, which is not the case. It's regulation is a setup that tries to mitigate risks out there, but it's certainly not the deciding factor of trust to happen. I think it starts indeed with a sound regulation, effective regulation. That's one element that needs to be there from a risk perspective. Then you have clearly the conduct of all stakeholders involved, which is the most important thing, clearly. And clearly, then you have effective supervision, who should be the monitor and to a certain extent the guardian of trying to mitigate risks out there. But it's a very difficult point, because very small incidents can have a huge impact on confidence in the market. If there is a fund with an unsuspected illiquid assets, that could have an enormous ripple effect across. So if this fund is portraying this, is showing this level of risk in a supposedly fairly low risk area, what else is out there? And clearly the things we've seen recently around Reddit and GameStop clearly is also not helpful in the perception around financial markets in general. So I don't think there is a silver bullet solution out there. The only thing is, everything needs to come together to mitigate the risks as far as possible without killing the market at the same time. I think that is also a very important thing to keep in mind, to strike the right balance there. But again, there's no silver bullet to enhance confidence in the market per se.
No, I take your point. It's not that simple, Gina. As Evert points out, you can't simply write a regulation that is going to instill trust in an investment audience. But what can the industry do to enhance trust and confidence, perhaps beyond regulation? Are there other actions, initiatives that can be pursued?
I think I will echo how important regulatory speed and supervision and enforcement, because when things will inevitably go wrong, but it's about how you resolve them. And here in the UK, as you know, we are very critical of the speed of those things being resolved. But I think more than that, it's also about fairness. It's about regulatory fairness as well, because you can't have one rule for firms and for customers and one for the regulators. So I think it's really important that there is this sense of fairness throughout the industry. Stakeholder communications is so important, but I think education is also important, because it's one area which I often feel is neglected, is that if people begin to understand about the industry, and it's not just the perceptions, it's the reality of the fact that finance and savings and investments and financial services affects every single part of their lives. And the language we use, if you start talking about financial health rather than just, it is a dry subject that people stay away from. So if they do get burnt when they get closer to it, then they naturally feel that it must be something that the industry is doing wrong. And I've always felt that if we could be more open in the way we communicate what we do, we simplify our language and we educate people into why financial services, the markets, investing, savings, pensions are so vital to their financial health, then I think we will build trust. So education, I think, is a key part. There is no silver bullet, but it's about regulation, communication, and education for me.
Yes, that's a wonderful, catchy trinity of principles there. I've got time, I think, just for a very quick question, which I'll put to all of you. Just very short answers, because we've only got a minute left. Our audience member asks, are you seeing any early indications of the impact of Brexit? Marco, any early indications? It's only February.
No early indications. I think it was well prepared by everybody, and I think we see no big issues right now. It seems to be a very smooth transition, from what I can tell.
Yes, that's what I'm hearing. Evert, would you agree?
Yeah, I think I would agree for the fund area, where a lot of preparations have been going on. So no early indications. I think early indications are more in the area of around the share trading obligation and derivatives trading obligation. Clearly, a lot of shifts there.
clearly. Gina, and anything from your point of view as a practitioner?
I think from UK, we've been shocked at how quickly some things have moved, like derivatives markets. But for us, it is wanting that certainty. We desperately need to have the memorandum of understanding, so we have some clarity as to the infrastructure and the systems. And for us, the other thing, of course, is repatriation of the committees and the regulation, which we need to see. So disruption, not now, but I expect it will come.
It may well do. We'll keep covering all of these developments, but that's all we have time for in this session right now. So my thanks to our panelists, Gina, Marco, and Evert, and to you for your time and your questions. Remember, you can head over to the sponsor page to visit the sponsor hubs at any time and share your thoughts on social media with the hashtags CrossborderLU at Crossborder 2021. Coming up is an interviewee I think you'll be keen to hear from and to question. It's Jim O'Neill, former Goldman Sachs chief economist and chair of Chatham House. That's coming up at 10:35. But from me and from our panel members, it's goodbye.